Hey there. So, have you ever heard of something called a 1031 exchange? It's like a super cool tax strategy that can help you save a ton of money when you're selling and buying real estate for your business or investments. Let's break it down. Basically, with a 1031 exchange, you can sell a property you own and then buy another like-kind property within 180 days without having to pay capital gains tax, depreciation, recapture tax, or even sales tax. How awesome is that? There are two main types of 1031 exchanges: forward exchanges and reverse exchanges. Forward exchanges are when you sell your property first and then buy a new one. It's pretty straightforward and easy to do. Before you sell your property, you'll set up an exchange agreement with a qualified intermediary, QI, and create a qualified escrow account to hold the sales proceeds. Once you sell your property, the money goes into the escrow account and is only released when you're ready to buy the replacement property. You have 45 days to identify a replacement property and 180 days to complete the purchase. It's like a little race against time, but totally doable. Now, let's talk about reverse exchanges. This is where things get a bit flipped around. With a reverse exchange, you buy the new property first and then sell your old one. The IRS has some guidelines to make sure everything is done correctly. There are two types of reverse exchanges: exchange last and exchange first. In exchange last, the QI buys the replacement property and holds onto it until you sell your old property. In exchange first, the QI buys your old property while you acquire the new one. In both cases, you have 45 days to identify your old property and 180 days to sell it. It's like a real estate puzzle, but once you figure it out, you can save a bunch of money on taxes. How cool is that?